I think that's a question which we will continue to debate. We have Sanjay Parekh joining us. He's founder and CIO at Sohum Asset Managers. Sanjay, great to have you back on the program. Thank you very much for your time. So my question is simple. What from here, according to you, Sanjay?
Yeah. So the analysis you've done is so right, and I mean it's certainly insightful. And I just give my perspective. So one is a near-term reaction that most of them expect, and that can come. I mean that's absolutely possible. But I think India never had been so good. I mean, in my 27 years, I've never seen a combination of banking balance sheet so good, the corporate balance sheet so less levered, the government fisc in place, and the household balance sheet was always stronger. So this combination of all four balance sheets looking so strong, I think shows. I mean, that is one of the reasons for this resilience. And India clearly is an outlier in a global where growth is scarce. There are concerns, and we will be the fastest growing economy in the world. Then, of course, some of the things like we have political capital, things like GST, IBC, which is very, very important. All of them. I mean, you see the whole consumption engine we have, the infra engine. We are here where we will have capex spend ahead, and we have the government balance sheet is in place. So all of it is clearly, structurally very, very positive for India in the next 5 to 10 years. Having said that, as you put it rightly, valuations are not cheap. If you compare with emerging market or our averages as well, and we may see some time correction, some price correction, but that's part of the course. In the next 5, 10 years, it really won't matter.
Sanjay, evening. This is Rima here. Will the FI money come in despite the relative valuation premium of India versus its emerging market peers is double of historical levels? Will the FIs be able to invest in India despite this valuation concern?
Yeah, so Rima, it's a very valid point, but one is a top-down view and one is a bottom-up view. Now, today also within index, there are some of the stocks which are very expensive, but some of them, I would say very reasonable. So it would be a stock pickers market or themes. There would be, value seekers, and that's how there will be bottom-up, picks that will happen. So as Prashant also recently said, if you look index on 1 year, it's 9%, but the divergence is return is so stark, and you could have never imagined that the top 3 of the top performers are PSUs. So you will see stock picking ahead, and there will be opportunities, and I think that's what global investors will look for. And India is top down also. It's like a growth stock, which is not cheap. You keep looking for it to come down on valuation, but you don't get that cheap. So I think we fall in that bracket. India as a stock falls in that bracket, and I think that we will have some reactions maybe, but that will be a buy or decline longer term. Also, one more thing I want to point out is, let's say fixed income versus equities. Let's say fixed income gives you 8%, further higher from here. But on a post-tax basis, it's still 6%. So then, and Indians are significantly over-invested in other instruments like fixed income, fixed deposits, real estate. And today also in equities, the exposure is less. So just imagine, even if they were to get a 10% return on index, and they were to just invest into an ETF, that itself is good enough. And valuations also on 24, yes, we are expensive, but as we move to 25, and let's say if you look at earnings more like 1,080 to 1,100, and if we think India deserves 20 times, then we're talking about 22,000 over an 18-month period. So while it could be back-ended, we could have some time correction and price correction, but over an 18 to 24-month period, we are not that expensive. And I think that is the perspective when global investors would take.
Sanjay, in terms of not building a portfolio, but adding to the portfolio, what are the kind of names with the 2, 3, 4-year kind of perspective that you'd be comfortable buying now?
So I think, financials still, I think, the entire financials, even if you buy from today's price, some of the leading private sector names, over a 2-year period will give you very good returns. Even on a 12-month period, you'll see some good returns coming. So we think there is definitely scope there. And we did some work around Bank Nifty around 35,000, and we said, can this double in 4 years? And we looked at the valuation from then from 35,000 to 70,000 in 4 years, and the answer was yes. And it was almost earnings led, and not even big de-rating upwards. And we are on the best cycle on the banking side. So that is one area I think there is a lot of opportunity. The second piece is, of course, some of the capital goods, the larger capital names. Some of them are expensive, but still the larger names are reasonable. If you were to take up that utilization level in India are high, there is a capex spend. We will be in a year of elections, and that will certainly again, qualify. And then, of course, you have to pick up sectors or stocks, because within stock you get great opportunities. The volatility is high, and then you have to pick up themes. But from our perspective, on entire domestic theme, be it retail, telecom, even real estate, auto, all of it, we think there is a case to be bought at a price, of course, not at current prices. But global themes, IT, pharma, some of the global names, we are a little cautious. I think that theme will remain for a while because world is chaotic, and we will have some impact on the global plays that we are directly or indirectly linked.
Okay, so you've got comfort in the domestic demand plays while you're still uncertain about the companies with linkages to global demand. We've run out of time. Thank you very much for joining in on this special day. Get into a break, but as we do that, here is some expert commentary that we got through the day.
I think markets are discounting most of the positives today.